From a young age, we are taught that financial success comes from a simple habit: work hard and save your money. But leaving your extra cash in a standard bank account guarantees its decay. The force driving that decay is inflation. Over the last few decades, the cost of living has crept up by an average of 3 to 4% every single year, eroding your purchasing power while you sleep. This line chart shows why a savings account fails. The flat bottom line represents the near-zero yield of the bank. The steep upward line is inflation. When the cost of living rises faster than savings grow, you lose real money. To preserve your wealth, your money must grow faster than the cost of living. This is why the wealthy use the stock market. Buying a stock means acquiring a fractional piece of a real functioning business. As a part owner of that business, you generate a return in two specific ways. First, through capital appreciation, where the company becomes more valuable and its price goes up. Second, through dividends, where profitable companies share their quarterly earnings directly with you in cash. Defeating inflation requires a shift in behavior. You have to move from being a passive hoarder of cash to being an active owner of producing assets. When you combine that underlying stock growth with reinvested dividends over a long period, you trigger compound interest. The profits from your initial investment start generating their own returns. $250 monthly at 8% forms a flat deposit baseline. The exponential interest curve overtakes it, hitting $1 million by year 40. In one more decade, it spikes aggressively to over $2.3 million. While your contribution amount and rate of return are the inputs, the duration of the investment acts as the multiplier. A modest salary becomes millions of dollars if given enough decades to grow. Success in the market depends on a strict sequence of operations. Step 1 is the total eradication of high-interest consumer debt, such as credit card balances. This comparative bar chart shows why. There's no logic in chasing an 8% market return while you are losing 20% to credit card interest. The interest you pay to the bank will always outpace the profit you make in the market. Step 2 is building a cash emergency fund, covering 3 to 6 months of living expenses. Because the market fluctuates, this cash shield ensures you never have to sell your stocks at a loss just to cover an unexpected bill. Once the foundation is set, you need a system for how much to invest. A reliable framework is the 70-20-10 budgeting rule. You allocate 70% of your income to living expenses like rent and food. You round 20% into your investment portfolio. The final 10% is for hobbies, vacations, and pure fun. Following this specific sequence provides the capital for investing while preventing the psychological burnout that often derails wealth-building plans. To keep as much profit as possible, you should use tax-advantaged accounts like a Roth IRA in the US or an ISA in the UK. These accounts legally protect your investments from capital gains taxes, allowing them to grow tax-free. Modern investing apps have also lowered the barrier to entry through fractional shares. If a company stock costs $500, you can buy $5 worth of it from your smartphone and own a precise fraction of the business. The question then is what to buy. Many people assume investing requires staring at complex charts and trying to time the market, but active day trading is a high-stress environment where the majority of participants lose money. For the long-term investor, the statistically superior strategy is to buy an index fund or ETF. Instead of searching for a single winning company, you buy the entire market. An index, like the S&P 500, operates like a sports league for the 500 most profitable companies in America. When you buy the fund, you own a piece of all of them. If one company fails, the index automatically removes them and adds a growing competitor in their place. This self-cleansing mechanism has provided a 10% long-term annual return. That growth is driven by the historical trajectory of technology and innovation companies, like Apple, which have dominated the index for decades. By relying on collective corporate growth rather than individual guesswork, passive index funds consistently outperform the majority of professional hedge fund managers over the long term. To reduce the impact of a single market downturn, you can diversify beyond the top 500 companies. A total stock market index fund captures the growth of thousands of medium and small-sized businesses as well. You can also expand globally. Adding an emerging markets index allows you to capture the massive economic expansion happening in regions like India and South America, ensuring your portfolio profits when other countries boom. Setting up the portfolio is the technical part, but the real challenge is psychology. Market crashes are a guaranteed feature of the economic cycle. They are not a signal to abandon your plan. The rule is to hold for the long term and ignore the daily headlines. Historically, the market has always recovered from crashes to reach new highs. There are only 3 valid reasons to sell your shares: a personal catastrophe that depletes your emergency fund, a permanent change in a company's business model, or reaching your target retirement date. Building generational wealth relies on the mathematical probability of long-term corporate growth and the discipline to follow this sequence of operations until the end.